Welcome and thank you for attending the Franklin Templeton session here at the first ever virtual RPAG National Conference, Reimagine. My name is Matt Foster, National Retirement Consultant based here in Houston, Texas, and we hope that you and your families have had a safe and healthy summer. As much as we'd love to be doing this presentation for you in person and overlooking the beautiful Pacific Ocean in Laguna Beach, California, we know that this is the best thing to do here in what has been a very trying year. Amidst all the disruption from the coronavirus and economic shutdowns, 2020 has been an exciting year for our firm as far as increasing our footprint goes. In February, Franklin Templeton announced the acquisition of Legg Mason, and on July 31st, we completed this acquisition, making our new combined firm a $1.4 trillion asset manager with over $125 billion in retirement assets alone. What that means for you is that you can expect continued investment excellence and rigor with names like ClearBridge Investments, Western Asset, Brandywine Global, and all of the legacy Legg Mason affiliates, along with Franklin, Templeton, and Mutual Series, all under the Franklin Templeton name. We believe the combined organization will be stronger and better than ever. Our diversified range of strategies and combined investments in new technologies will keep us at the forefront of innovations that can help transform our industry. Over the coming weeks, you'll begin to hear from your Franklin Templeton workplace retirement team to share with you our DC insights, tools, and value-add resources to support you and your clients, and we look forward to sharing our vision with you. Thank you for your partnership and your trust in us with your clients. Please don't forget to stop by our virtual booth as we have a lot of great things to show you there, and we hope you enjoy our presentation and have a great conference.
Hello, everyone. My name is Corey Hardy. I'm a portfolio specialist from ClearBridge Investments, and today I'm going to be going through the anatomy of a recession presentation, what to look for, and where we're headed. This presentation is extremely important in today's environment where things really are completely unprecedented. And I am sure I am not the first person to use that word to describe the type of environment that we're in. In fact, as you can see from slide 2, that word has absolutely exploded in terms of popularity. Folks have been using that to describe the situation that we've been seeing. And really, it's no wonder because this pandemic has really been a totally different experience for investors. Unless you've been alive for over 100 years and you experienced the Spanish flu, this is unlike anything else that you've ever seen. So unprecedented really is the best word to characterize the type of environment that we've been in. But this isn't to say that this time is totally different. And unfortunately for investors, this is where the average investor starts to get portfolio decisions wrong, is that they start to think this time is different. And we kind of characterize that as panic attack mentality. So here on slide 3, you can see that if you look at global stock returns over the last several years and overlay on top of them what we call panic attack scenarios, investors tend to do a really poor job of staying the course during times of stress for markets. So recently we went through the global pandemic. That really was a unique time and place in terms of history. You had a kind of manufactured shutdown because of social distancing and the need to keep people away from one another in order to stem the flow of stem the spread of the virus. But unfortunately, in typical times, investors tend to whip themselves into a frenzy because of some sort of bad news. They have what we call panic attacks. They sell at lows and they don't get back in until markets work their way higher again. So it's a hugely capital destructive behavior that the typical investor falls victim to. And unfortunately for them, their investment returns reflect that terrible capital destructive behavior. And you can see on slide 4 that the average investor has annualized just 1.9% returns over the last 20 years. Think about that for a second. 1.9% year in, year out for 20 years. That is abysmal, especially when you consider the fact that inflation over that exact same time frame was 2.2%. So on a real basis, on an inflation-adjusted basis, people actually lost purchasing power as a result of that panic attack mentality. So the real crux of the issue for investors is that they tend to react very slowly to good news, and then they react way too quickly to bad news. So much so that there is an old adage on Wall Street that the market tends to take the stairs up, but the elevator down. So what you're looking at here on slide 5 is every single 15% drawdown that we've seen on the S&P 500 going back to the mid 50s. And you can see on the bottom there, the median in blue, the typical market kind of response headed into and out of a 15% drawdown is it takes a while for the market to climb to that peak. So this is, again, in line with this idea that folks tend to react to good news very slowly. So they think, markets are grinding their way higher. I'm going to wait for a better entry point. And then it takes about 16 months typically for the market to hit that peak. Usually, unfortunately for that average investor, that's about the time that they're going to start to feel good about allocating to the market. And then the bottom drops out from underneath them because of one of these panic attack scenarios, whatever the news might be. And from peak to trough, it's a very quick decline of 15%. Usually it only takes about 6 months. And then this is the really bad news for investors. Smart money tends to come in and snap up those discounts that big drawdown affords. And the market gets back to its prior peak very quickly. So it's slow to put in that peak. It's very quick to go peak to trough, and then very quick to snap back to that all-time high. So if you're one of these typical investors who's slow to react to that good news, you're getting in at a high point, you're probably having that panic attack at the low point, and then the window of opportunity for you to get back in at some of those discounts is very, very short. So hugely capital destructive behavior that the average investor does a really poor job compounding wealth over time as a result of that. So how did this most recent pandemic-related sell-off stack up relative to this typical performance since 1950? Well, as you can see from slide 6, there is a reason why everybody's using the word unprecedented. This truly was an unprecedented environment. It was the fastest bear market in U.S. history. So we almost cut the previous record in half. It took 22 trading days for us to go down 20% on the S&P 500 starting in March or ending in March. To put that into perspective, the previous record holder was September of 1929, which was 42 trading days. That was during the Great Depression. So this was absolutely wild how fast this drawdown happened. And really, there's two key reasons why that drawdown happened so quickly. Number one, markets were at the full side of fairly valued headed into this drawdown. So we were coming off a very strong 2019. The S&P 500 was up over 30%. And headed into February of 2020, the S&P 500 was trading at a forward earnings multiple of about 19 times, which is on the more full side of fairly valued, some would say. So what you're looking at here on slide 7 is sort of reflecting that melt up higher. And this is something, unfortunately, we can only see in retrospect. But it's that melt up higher that we saw through 2019 and in the early part of 2020 before the outbreak of the pandemic and the basic economic shutdown. But for those of you who are not, data nerds and are not looking at slides like this all the time, I'm going to take a second to explain slide 7 because it can be a little wonky to look at. So what you're looking at is every single bear market since 1928. And what we've done is we've said, what is the typical market response headed into and out of a bear market? So the 9 months before a bear market or a 20% drawdown on the S&P 500, and what does it do the 9 months after? That gray line in the middle there, that's the average market response. And that shaded blue area, that's a typical deviation from that average response. So whether you're above or below that gray line, as long as you're in that shaded blue area, you're still a normal-ish type of market return. And then that dark blue line, that's the market that we're experiencing today. So as we got into that bear market back in February and March, you can see that we were really melting up way higher than you would typically see in advance of a bear market like that. So markets were at the fuller side of fairly valued, which is one of the reasons why that sell-off was so dramatic. And then the second reason really dovetails off the first, which is as selling pressure started to mount, as that panic attack mentality started to set in for investors and people were selling more and more, because we had such strong returns through 2019, and broadly speaking, strategists and economists were saying that things were looking really good for markets in the economy, people had started to build up leverage. So market participants, rather, had built up leverage. So you could see commodity trading accounts, hedge funds, certain closed-end funds, certain ETFs, if they had leverage as a component of what they're doing in terms of investments, a lot of them were toward the higher end of that allowable leverage. And then as that selling pressure mounted, it started to put pressure on those folks who were utilizing leverage, and it created a liquidity crisis. So that's why that selling pressure got so dramatic. We were down over 34.5%, and then in a very short order, and then that peak to bear market territory was the fastest in U.S. history. And those are really the two big reasons why it happened like that. So now we were left with a scenario in March where everyone at ClearBridge was basically saying, well, look, it's a foregone conclusion. We're going to have a recession. How long do we think this is going to last? And what we did, and on slide 8, you can see this, we looked at the average length of a recession throughout history. So going all the way back to basically the turn of the century, we wanted to see what was the average length of a U.S. recession. And it does come in at about 13 months. But you can see from this chart, they can be as short as 6 months, which you saw in 1980, or as long as 43 months, which you saw during the Great Depression in 1929. So we were saying, because of the policy response that we had seen in very short order, we thought that this was going to be a very short recession, and we had been in the camp that it was probably going to surpass 1980 as the fastest recession in U.S. history, and we're still in that camp. We think the recession is already over. And a big reason, like I mentioned, why we felt that way is because of what our strategist, Jeff Scholze, calls the Fed tsunami. We saw a massive amount of policy response, both from the Fed and the government. And basically, the Fed had implemented a just staggering amount of quantitative easing. And to put that into perspective, they increased their balance sheet by about $3 trillion. So we went from $4 to $7 trillion worth of debt on the balance sheet. And that all happened within a short window of several months. So what we wanted to do was we looked, what does this look like throughout history? The last largest year in terms of quantitative easing, bond buying from the Fed was 2013. In that 1 year, you saw $1 trillion spent evenly over each month. So $1 trillion over a year, that was the largest amount in history up until this year, where we did $3 trillion in about 3 or 4 months. So we did 3 times the amount of stimulus in close to a third or a fourth of the time. That's absolutely massive amounts of liquidity being pumped into the system. Anytime you have more liquidity in the system, markets are going to favor that liquidity, especially over the short to intermediate term. So we were of the opinion that markets were going to continue to grind their way higher, and this was going to be a short, shallow recession, one that is probably going to be the fastest in U.S. history. And it's not just the U.S. who acted swiftly and aggressively, it's globally. So globally, you're seeing massive amounts of liquidity pumped into the system. And on slide 10, you can see that it's relative to the financial crisis, a massive amount for every single country, not just here in the U.S. So what you're looking at on the left side of these bar charts are the policy response relative to their GDP during the financial crisis. And on the right side, you're seeing what we did relative to our GDP during this crisis. And you can see people acted very, very aggressively globally to pump liquidity into the system to try to stem off the effect of the economic shutdown. So stocks, you're kind of left as an investor thinking, what should I do from here? Because markets really snap back higher. And what you tend to see throughout history is stocks will tend to anticipate recovery. So when you're starting to see that policy response, market participants act ahead of the data. And they'll typically, what you're looking at is every economic expansion through time all the way back to the 1940s. And you're looking at how long before the recession did the market start to work its way higher? And then what was the peak to trough for the S&P 500 during that recession? And usually on average, you see the market start to work its way higher about 3 months before the end of that recession. And peak to trough, you usually see about 30% declines. So we exceeded that peak to trough decline. We were down 34.5%. And we started to work our way higher, probably around the average, maybe a little late. But again, because this is the shortest economic recession in history, in our opinion, it probably is not the best apples to apples comparison. But the point of this chart is markets are forward discounting mechanisms. So you're typically going to see them work their way higher before the all clear signal has been put in. But that can be somewhat misleading for investors. So markets also tend to be prone to what we call counter trend rallies. A better way to think about this is a head fake. So what you're looking at on the right side of this chart on slide 12 is the market's performance headed out of the global financial crisis from 2007 to 2009. And you can see within that downward trend, there were several periods of strong uptrends or counter trend rallies or head fakes where market participants were probably whipsawed a little bit. So if, for example, if you're enduring a 51-day rally of 12%, in that moment, you're thinking, shoot, I'm really starting to miss some upside here. I should probably get invested, only to see the market really work its way lower. And then the best example was that 31-day, 24% rally. That's a really strong month for the stock market, and it's a tough time to stay on the sidelines. So investors tend to get whipsawed toward the beginning of an economic recovery because markets are prone to these counter trend rallies. On the left side of the chart, you can see that over time, these counter trend rallies have actually become bigger and bigger in terms of their magnitude. So coming out of this, we had been cautioning investors, you really need to look for signs of a durable bottom. You do not want to get whipsawed by one of these counter trend rallies because, again, average investor tends to buy and sell far too often, and this is a perfect disaster scenario for the average investor. So with that in mind, we created a dashboard to try to help contextualize where we were in the recovery, both economically and markets, for advisors and for clients to try to put into perspective where we're headed and did we see a durable bottom or should we expect one of these counter trend rally or head fakes on the horizon? So this U.S. recession recovery dashboard that you see on slide 13, this to me is really the kind of the heart of the presentation, the real gem of this presentation. A lot of these presentations are purely informational, whereas this portion of the presentation is instructive. It actually helps to synthesize all the information that we're giving you and put it in a digestible way where your most sophisticated client can look at this simple stoplight analogy and think, okay, I understand this. It's not too simplistic. You're not condescending to me. There's a lot of work that goes into this. And then your least sophisticated client hopefully will look at this. Maybe they don't understand each individual indicator, but they understand that the green signal and the overall signal means that it's a great time to be re-risking their portfolios, and they don't have to worry about those head fakes. So these are 9 indicators that are broken up over 3 kind of fault lines of a recovery. So confidence, that's consumer, business, investor confidence. Economic indicators, and we have several different indicators that we look at over the economy. And then lastly, financial conditions. Importantly, you've seen these very much so increase in positivity over the last 3 months. So we have gotten significantly more positive over the last 3 months as a lot of these indicators and a lot of the data has started to come in as extremely positive. 2 that just recently changed. I'm recording this in early September. And just recently, credit spreads went from yellow back to green. So credit spreads really blew out. We're looking at high yield there. They really blew out during this crisis. They went from something with a 3 handle to around 11%. Now they're back down to something with a 4 handle. So they've come down pretty dramatically. They're not down as low as they were before the crisis, but they're darn close. So those are now green. And then housing starts has actually went in 3 months from red to yellow to green. Obviously, you're seeing a significant shift of folks leaving cities and going to suburban dwellings, myself included. My wife and I have a 6-month-old, and we've actually just left New York City, which is where ClearBridge is based, and we moved to the New Jersey suburbs. So housing starts really strong because of that effect, and those have gotten significantly more positive. But I can tell you how great these indicators are until I'm blue in the face. The proof is in the pudding. How have they done over history? And as you can see from this slide on slide 14, over the last 7 recoveries, we've done a pretty good job of showing you when that durable bottom has been put into the market. So typically, we're going to go green on this overall signal about 1 month before the end of the recession, but 1 month after the market has bottomed. So we're going to be a little late in terms of market action, and we're okay with that because we do not want to subject clients to re-risking their portfolios ahead of one of those counter trend rallies. Historically, we've never had a false green in the back-tested data, but we do want to make sure we're a little late on that because we'd rather be a little late then subject you to that sort of whipsaw. And the whole point of this was to create a durable signal that you can look at and feel good about re-risking. We were a little late relative to our long run average. So we were about 3 months after the bottom because of the unique situation here with the COVID outbreak and the sort of manufactured global shutdown of economies. But we feel good about that. We think that at this point, the overall signal is green, and people should continue to feel good about allocating to equities globally because of the positive data that we're seeing from this dashboard. And a lot of folks tend to push back on that, thinking, well, that's nice of you to say, but the markets have really worked their way higher. We're up over 50% from the lows. We're back at all-time highs. Now's not the time I want to be putting money to work. And historically, that would be the wrong way to think about it. So we believe, ClearBridge has been saying for over a year now that we believe we're in a secular bull market. So if you're looking at all economic expansions and the market performance during an economic expansion, all the way back to the 70s, the average length of a market expansion is about 74 months, and the cumulative return that you see is about 96% returns. But not every expansion is the same. You have secular bull markets, secular bear markets. We do think we're in a secular bull market. So if you strip out those 3 secular bear markets, rerun that average, just looking at the secular bull markets, which are much, much stronger, much longer, your average jumps to 88 months in duration and 150% returns or thereabouts. So just saying we're up over 50% from the lows and we think, because we're at all-time highs, we don't want to be invested, that's the wrong way to think about it, in our opinion. You still have potentially a lot of upside from here, but the type of shape of recovery should dictate kind of where we go from here. And as you can see from slide 16, there have been 100 different ways that people want to characterize this recovery. V-shape is the very typical kind of thought process where people think we're going to see a V-shape, that big drawdown, and then a sort of linear path higher. What our strategist has been saying is that we're going to see this Nike swoosh shape on the top right, where you see that big drawdown, you saw a very fast return to all-time highs, but growth is now going to start to moderate a little bit. And we're not going to see this massive, day in, day out, big returns for the market going forward. And the market's going to start to trade more in line with earnings on a go-forward basis. And that multiple expansion that we've seen is going to start to slow. So yes, we still have a lot more upside, but the fast, big chunky returns are probably starting to slow. And we're going to see the market trade more in line with earnings on a go-forward basis. But we do think it's a time to be invested, and we don't think it's a time to be waiting on the sidelines for a big pullback. That is a classic market timing mistake, and it's one of the reasons why investors do a poor job of compounding wealth over time. So I've gone over a lot of the positives, and to be clear, ClearBridge is very positive on both the market and the economy at this point, but it is worth noting a couple of the negatives, a couple of the places where we could potentially see weakness start to come to fruition. And one of the top of mind data points in terms of what could potentially go wrong is services. So the epicenter of this downturn was services, and you can see that on the right side of slide 17. Services really took it on the chin because of the unique nature of this economic shutdown. However, looking at historical context all the way back to the 60s, services are typically not the ones that take it on the chin during a recession. Actually, from this chart, you can see services are one of very few areas that continue to grow on average during a recession. So this was a very unique recession in terms of services portion of our economy actually taking it on the chin. And to us, one of the big reasons why we're continuing to watch that was because at the time that we put this slide together, actually our curve was in the US here was still grinding higher. That has dramatically changed since quarter end. We're now in September. This curve has come down meaningfully. But I don't mean to sound like a Game of Thrones nerd here, but winter is coming, and you could potentially see this curve start to tick upward again if the virus starts to spread more in colder weather. And one of the things we really watch, if that does come to fruition, is the older population, those folks who are most susceptible to complications from the COVID-19 virus. And I'm not trying to make the case that 55 is quote unquote old, but if you do look at spending here in the US, those folks who are 55 years or older do account for a massive percentage of our spending here in the US. The consumers, about 70% of our economy, 40% of spending, total spending in the US is done by people who are 55 years or older. So if you do start to see that curve tick higher, those folks who are most susceptible to complications from the virus are those who spend a lot. So that could have a pretty detrimental impact to our economy. And it's something that we're watching very closely as we head into the winter months, and what could potentially happen with that. One of the other things that we've been kind of keeping an eye on is, yes, we've had these massive amounts of liquidity. I mentioned earlier that Jeff Schulte keeps saying the Fed tsunami. And that's great because it addresses a lot of the liquidity concerns that we saw because of the economic shutdown. But solvency risk still remains. So you have a lot of companies that are still somewhat dying on the vine, waiting for help. Even though we were very fast to act, there's still a lot of money that needs to get in the hands of small business owners. And small business owners, and you can see on slide 20 that bankruptcy filings and unemployment, they tend to go hand in hand, which is probably the most obvious slide in the deck. But you can see that bankruptcy filings really have not come up in line with unemployment. That may stay that way because we have a lot of temporary workers. But if you see that virus start to tick up again in the winter months, temporary could become permanent very quickly. And that's a big negative because these small, micro, medium-sized businesses, both public and private, they make up a huge portion of our economy. So we're looking at corporate profits here on slide 21. A lot of people tend to think, because we talk about the S&P 500 so much, that what we're looking at here is S&P 500 profit margins, and it is not. Again, the whole point of the dashboard and the presentation is to kind of have a finger on the pulse of the broad economy. S&P 500 are the 500 best companies of the world. It's not indicative of the overall U.S. economic conditions. What we're looking at here is something called NIPA profit margins. It takes into account those micro, small, medium-sized businesses. And that's really, really important because close to 60% of the U.S. labor force works for a company that has less than 1,000 employees. So if you don't have a finger on the pulse of those smaller businesses, both public and private, then you're missing the vast majority of the economic conditions here in the U.S. And unfortunately, those profits have ticked down pretty dramatically as a result of the shutdown. Positive news, though, since we printed this, you're starting to see those tick higher, which is a good thing. But again, we've got to wait to see what the winter months does to that data. And again, this is that dynamic I mentioned earlier. If you do see the winter months hit us hard in terms of the spread of the virus, you could see those temporary laborers go into a full-time layoff very quickly. And there's still a lot of folks that are on temporary furlough or on temporary unemployment. So that's something we're watching. The positive note to all this is we still have a ton of dry powder to implement liquidity to try to stave off some of the negative impacts if we do see that bear case come to fruition. So we've talked a lot about the PPP initiative, but you can see the Fed has a lot more lending facilities than they've implemented in terms of that initiative. That Main Street lending program is getting a lot more coverage since we printed this because the Fed is acutely aware of the issues that Main Street is still having relative to Wall Street. So markets have been off to the races since the low of this pandemic, but because of the manufactured economic shutdown and the need for social distancing, Main Street has really continued to take it on the chin. There are a lot of businesses that are really hurting: travel, restaurants, barbershops. It's really difficult for these small businesses and companies to operate in this environment. So these companies and businesses really need this liquidity. And the fortunate part is the Fed has already outlined, as you can see on slide 23, different ways to get that money into the hands of those who need it. And this kind of dovetails into a broader concern about debt here in the U.S., which is, do we have the money to be doing this? And I understand where folks are coming from when they think that. But as you can see from slide 24, we do have the capacity to continue to increase our debt burden here in the U.S. What you're looking at here is our debt relative to GDP in terms of the Fed's balance sheet. And we have about 37% debt to GDP relative to the Fed's balance sheet. And the best comp we have on this slide is Eurozone. They're at about 60. So we have a lot more room to continue to increase that debt to try to stave off economic weakness. And then Japan is also on this slide. Japan is probably not a great comparison for us for a multitude of reasons, but the whole point of Japan being on that slide is that they're at about 124 or 123. That's a really big number. The point is you can continue to grow your economy and continue to grow your debt burden, and it's not going to necessarily come home to roost today. So yes, the US debt issue is a problem. It's just not necessarily a this cycle problem. And even though it may seem like a massive amount of debt that we have today, if you look at some of our peers, we have a lot more room to run in terms of capacity for that debt. And then that's not just the Fed. You can see this is what you're looking at here is the global stock market, and companies themselves have a lot of dry powder to address any weakness. So about 18% of the total market cap of the entire global market index is cash. So if we do see weakness come to fruition over the coming months, and we do see another flare up of the virus such that markets tend to go into turmoil, a lot of companies are well capitalized and can probably go through some lean times because of that big cash on their balance sheet and all that dry powder. So we're not necessarily too nervous of what could potentially happen. And then last but not least, this is just kind of a call to action. Get invested. Even though we've been up off the lows, it is not a good excuse to not be invested because we're at all-time highs. You have had 255 all-time highs since 2010. It would be a terrible thing to say, okay, we're at all-time highs, I'm not investing right now. Get invested, re-risk your portfolios. We are definitely not proponents of using the dashboard that we went through earlier as a way to market time. We want you to get invested and stay invested. If you're going to use it as a way to think through investments, please use it as a way to re-risk or de-risk, not as a wholesale go to cash or get invested. That's a fool's errand. Get invested, but we do think now is the time to be re-risking portfolios. The all-time highs is not a way higher over the next 10 years or thereabouts. We saw a similar period to this in the 1980s to 2000s, 1950s to 1970s. The cumulative return tends to be massive. The all-time highs number tends to be massive. We think we have a lot more room to run. And we've already experienced a very big drawdown, much bigger than what you would typically see in the average secular bull market. So we think now is a really good time to be invested in the equity markets overall. So in aggregate, ClearBridge is very positive on both the market and the economy. Every day, we're getting more and more incremental data points, as you can see from our dashboard, that make us more and more positive. It's not to say that we can't see potential drawdowns in the coming months because of maybe scares as we enter the winter months, but those would be opportunities to put more cash to work, not reasons to fall victim to that panic attack mentality. So that is all I had for the prepared comments today. I did throw up slide 27 in the Q&A session. I'm happy to address any of the topics on this slide, so we can go through the U.S. presidential agenda, because that's extremely topical because we're in an election year. We can go through debt in more detail, which we've touched on a little bit, but folks, obviously that's a pressing issue for all the reasons I mentioned. And we can go through valuations, volatility, anything on this slide is fair game. Or if you folks want, we can backtrack and go through in a little more detail, something I touched on that maybe you want a little more clarity on, or we can change the narrative completely and go through something that maybe I haven't brought up that you think is topical. So at this point, I'd love to take any and all questions that you folks might have. So thank you.
Thank you for joining me today. I'm Mickey Stralo, Senior Marketing Strategist. I'm here today to help you better understand marketing technology and help you find ways to grow your practice and attract more clients. I'll break down marketing technology and offer several tips you can use right now to help generate leads, save time, and grow your practice. Let's get started. First, let's quickly talk about the financial planning industry because it's undergoing rapid change, especially when it comes to communication. As you're well aware, baby boomers are aging and a younger wave of clients have come forward with different needs and preferences. How we communicate and get leads or prospects needs to change too, making a robust digital presence no longer a nice to have, but a necessity. Today, you may still rely on traditional communication methods, and that's great, but you'll also want to have so much more: a website, email campaigns, and even social media accounts. Traditionally, financial planning firms were masters at referral marketing, and rightfully so. Referrals can be a great source for generating new business, but today, there's technology available that can help you grow your business and attract new clients automatically. Consider marketing technology in addition to your referral efforts to grow your retirement practice. So, while referrals can and should remain part of your strategy to grow your business, they cannot be the only means of generating new clients. With the way you reach clients changing, it's likely time to consider investing in technology for three primary reasons. Grow your business faster. With the right technology, you can start automating how you gain new business. Deepen existing client relationships. Email marketing technology can help automatically stay in touch with clients with helpful and actionable information. Accomplish more with less. Typically, there's an upfront time and resource cost. Once set up, though, many of these tools run automatically to help you grow your business with less effort. Before we get too far along, I want to keep a few things in mind. First, you don't need to be an expert in technology or even be the person to manage it all, but you should have a basic understanding of what's important and how it fits together. Let's face it, your time is valuable and you're pulled in a lot of directions. Many of the advisors I talk to say their biggest obstacle is having the time and resources for digital marketing. We'll give you some simple and easy ways to get started. Some of you may have regulatory compliance and IT restrictions. Make sure you properly vet any technology you want to use. What technology are you using today? Do you have a customer relationship management system or CRM to store client information? What about a website that's user friendly and allows potential and existing clients to contact you? Have you built a social media presence on LinkedIn, which just simply means having a profile, description, and a professional photo? Whether you already have these in place or you're taking first steps to up your technology, we can help you understand how to add some power to technology and make it work harder for you. We believe there are two primary technology categories every advisor should consider. First, practice management helps you manage your existing block of business. Some examples include portfolio management software, rebalancing tools, or trade tools. Typically, advisors that I speak with are strongest in this area. The second primary category is marketing technology, typically used to attract, engage, nurture, and convert new leads into happy clients. Examples include email marketing, social media, search engine optimization, or SEO for short, or paid ads. Financial advisors often tell me this is an area where they want to improve, so we'll spend most of our time here. A question you may be asking at this point: how much should I spend on marketing technology? The answer, of course, varies. But according to a recent survey in 2019, 50% of advisors spend between 1 and 5% of their top line revenue on technology annually. Put another way, for $1 million revenue business, an advisor would spend roughly $10,000 to $50,000 on technology each year. Run the numbers for your own business and make sure you balance spending between both kinds of technology, practice management and marketing. Good news, many solutions have free versions. That way you can get your feet wet without a huge investment. I am now going to turn you over to my colleague, Brian Gawillo, Digital Marketing Strategist. He will focus on 6 technologies you should consider for your practice.
Thanks, Mickey. Now that you have a better understanding of the technology categories and how much you might invest, let's focus on 6 technologies you should consider for your practice. It might help to think about your technology as a collection of software or a stack of digital solutions to help manage your business and market to your clients. Each layered technology solution powers others. You typically want to start with a solid foundation and grow or stack more technology applications when needed. Just keep in mind, every situation will look different based on your firm and your business goals. First up, who's heard of Customer Relationship Management System, or CRM for short? A CRM system helps you keep track of leads, prospects, and clients. Think of it like a Rolodex on steroids. You can add in detailed information like birthdays and next steps, and it helps ensure those with a business need in your practice have access to the same information. Collecting information is only part of what a CRM can do. You can use your CRM to automatically capture information from your website to drive conversations and lead nurturing campaigns. CRM is typically the foundation of your technology stack. It makes client data accessible to other solutions like your website and keeps information updated. Some of the example vendors in this space are Salesforce, Redtail, and HubSpot. Next, invest in a professional website that's highly actionable and demonstrates your unique value. Think of this as your digital front door to your business that's open 24/7. It's often a first impression and can serve as the hub for your marketing efforts. So let me ask you a question. When was the last time you dusted off your website? Many of the advisors we speak with have a website, but is it leaving the best impression with your potential clients? Are you demonstrating your products and services and your unique value? Here are 3 things to consider when evaluating your website. First, your client's overall impression. Is your website well organized with relevant information about products and services? And what about engaging media and photos? Second, the performance of your website. Is your website optimized for search engines? And do you have analytics built into your website? What about how fast pages load and if they have errors? And then lastly, how easy your website is to use. Do you offer concise information about your firm and services? What about a call to action that's easy to see and simplified navigation? Some of the example website vendors are FMG Suite, Wix, and WordPress. The next must-have we typically like to see is email capture and email marketing software, which helps you collect with emails from potential clients and reach out to them. Here's why it's important. You want to turn website visitors into potential clients by offering the ability to learn more about your business and take action. Try and get email addresses by offering something in return. What about a consultation or additional information on popular topics? Some of the example email capture vendors are Opt-in Monster, Sleeknote, and SumoMe. Next, consider marketing automation, also known as email marketing to reach new contacts with targeted, personalized emails. Emails can be triggered the second a potential client provides their information to engage and encourage action at the exact time potential clients are considering your services most. Email marketing can also help you stay in contact with existing clients, especially during important planning dates like an annual review. Some of the example email marketing vendors are Salesforce, MailChimp, and HubSpot. Now, a couple of key tips. When you hear email marketing, you might think spam. I get it. Email marketing hasn't always had the best reputation, but done right, it's helpful, timely, and actionable. Using these 3 rules can make a difference. First, don't email someone unless they say it's okay. It's best to build a captive audience who want to hear from you. Second, provide an easy way to unsubscribe. And third, avoid spammy language. Don't use words in all caps, $signs, and exclamation marks as a general rule. For email marketing to be effective, you'll need to send more than just 1 email. After all, 80% of sales require at least 5 follow-ups, and only 2% of those sales occur after the first interaction according to a recent survey. we recommend creating an email journey, which is essentially a series of 3 to 5 emails over a short time, say a few weeks. Here's how it might work. On day 1, a client signs up and receives an email introducing you with content based on their interests. For example, retirement planning. 2 days later, another email goes out with a bit more in-depth information on the topic. For example, new retirement planning research. A couple of days later, the next email might be an invitation to an event. Maybe it's a webinar you're hosting. Next, provide some commentary on an industry trend or event. Finally, ask them to set up a meeting directly if they haven't already. Now, let's talk about appointment or meeting scheduling software. If you're not using this already, it can make your life easier both for you and your clients. The tool syncs with your calendar to show individuals your availability for appointments. Basically, it can speed up the sales process by eliminating the game of phone or email tag to easily save your staff hours every week. To get the most of your meeting scheduler, set up a link in your website, on your email signature, and as a call to action in emails. Some of the examples of meeting scheduling vendors are Calendly, Acuity Scheduler, and Doodle. Now, let's move on to video conferencing. It can work just as well as in person, and it's much more personal than simply picking up the phone. I'll offer an example from a colleague in North Carolina who has a relationship with an advisor in Illinois. He's working with that advisor because it's his parents' advisor, but he's never met him. They video conference during each meeting, and what he's found was that it helps add credibility by making it feel like they're taking the time for him. They can even share information using the video conferencing tool to aid in the discussion. Plus, it makes it easier for a partner to join. According to a recent survey by Redtail, well over half of advisors, 59%, are not communicating with clients via video, and only 7% are utilizing video to connect with clients on a regular basis. To me, this sounds like an opportunity. When you think about using video conferencing, here are some things to consider. Test it multiple times to make sure you're comfortable and everything works correctly. Trust me on this. Be conscious of what's visible on camera, making sure your background is professional and neutral. A blank wall always works well. And just because you turn on your video doesn't mean your client needs to. Many times it's enough for them to see you. Some of the example video conferencing vendors are WebEx, Skype for Business, and Zoom. The last must-have technology to consider is social media, specifically LinkedIn. One reason why is because 91% of executives rate LinkedIn as their first choice for professionally relevant content. Here are a few suggestions for using this powerful tool. Build your profile. Business owners and consumers typically Google you or check out your social properties first. Make sure your profile represents who you are and how you can help. Ask your marketing or compliance department for guidance. Next, make sure to connect with clients, business associates, referral partners, friends, and even prospective clients. Try and get at least 500 of these quality connections. By keeping tabs on clients, you'll have a better idea of how to get noticed. Then keep their attention by sharing content regularly, at least a few times a week. That way, you'll stay on the radar of clients and prospects. Make sure your content is valuable and aligns with your value proposition and the solutions you offer. Any content you share shows up in the news feeds of anyone you're connected with, so it's a great way to keep your brand front and center. I'll now hand it over to Mickey to talk more about how you can optimize your digital presence online.
Let's talk about your profile for a minute and the impression you're leaving online. With your website as your digital front door, it's often the first impression you leave on prospects. Millennials in particular look for advisors online, whether it's Google, LinkedIn, or Facebook. That's why optimizing your digital presence is one of the most valuable things you can do. When potential clients find you because your website is optimized for keywords, you increase the potential for a new pipeline of business. But how does it work? Search engine optimization, or SEO, is the process of improving your website rankings in search. Anytime someone Googles you, your name, or company website, you want it to rank high on the first page. The way it happens is actually through automated bots or crawlers that scan a website and look for several elements. The better your page performs when it's crawled, the higher rank you'll receive in search results. There are all sorts of fancy algorithms that determine ranking factors, and they constantly evolve. But some of the more basic ways search engines evaluate websites are how closely content on your website matches keywords people type into search engines. For example, small business, financial, professional. If your website uses some of those same keywords, Google is more likely to rank you higher in search results. Another way is how quickly your website loads. This is especially important for mobile devices. Or how many errors or broken links the crawler finds. If website visitors leave your website quickly, or if they have to visit multiple pages. And finally, how many other websites are linking to your website? The more links you have from other websites, the more credible your website appears to search engines. Now that you have a better understanding of how SEO works, you can take some simple steps to help improve your presence. First, optimize and clean up. This may mean deleting old accounts you're no longer using. Keep what's ranking well currently, and typically your company website and social media platforms. Next, focus on improving results that you own that appear first in search results. These web pages are most likely to be seen by potential clients. And finally, what are others saying about your competitors? Where do you have opportunities to differentiate yourself? What's your value prop? For example, do you specialize in working with small businesses or tax-exempt organizations? Now I want to share another option to help improve your results in search. Search engine marketing, or SEM, lets you increase website visibility through a paid ad that appears when someone types in a specific search query, like Best Financial Advisor in Des Moines. Paid ads typically appear as the first few search results, as well as the last few on the results page. The ranked results, which are earned, appear in the middle. In order to rank well in those free positions, you need to have great SEO. Search engine marketing is a lot like an auction where various businesses bid on the chance for someone to click on an ad. You can set up a monthly budget in the paid advertising platform, as well as specify what keywords you'd like to serve up an ad for. Every time someone clicks on your ad in search results, you'll pay according to the agreed amount. The more you're willing to pay per click, the more likely your ad will appear versus a competitor. Typically, Google and other search engines will suggest a dollar amount based on how competitive the keyword is that you've chosen. Just remember, before you start using paid ads, you want to have a website that's already optimized for search engines. Which is better? Search engine optimization, where you earn your ranking based on your website and keywords, or search engine marketing, where you pay for placement in search results. According to new media campaigns, search engine optimization is about 5.5 times more effective than search engine marketing or paid ads. This is most likely because people tend to avoid ads in search results. Ultimately, though, a two-pronged approach is best. Start by optimizing your website using an individual with SEO expertise before you start paying for ads. If your website isn't optimized, you likely aren't going to see as many visitors to your site, which potentially means fewer leads and less business. Another way to stand out in search results is to create a local business result using a free service through Google called Google My Business. To get started, simply type Google My Business and create an account to claim your business. Google will verify you by either a business email or phone. Once you've claimed your business online, you can enhance this business result in a variety of ways. For example, images, descriptions, business hours, contact information, and even the ability to schedule an appointment can help. If you have a meeting scheduling application, potential and existing clients can now schedule appointments with you directly from search results. A local listing provides a place for you to respond to reviews on Google and get insights into how potential clients are finding your site. If you're feeling a little overwhelmed at this point, I get it. It's a lot to think about, but you can do it. As we wrap up today, I want to leave you with some simple action items to help you get started. First, identify any gaps in your technology stack. Next, develop a budget and decide how you can allocate time and resources for technology at your practice. Remember, it doesn't have to all fall on you. Find resources that may be able to help you optimize your technology and consider using a digital marketing agency. Finally, be sure to check with your firm on technology already available. It's also a good idea to check with your compliance area about guidelines regarding implementing technology. If you want to get some more detail on some of the things I've just covered, I'd encourage you to check out our video series focused on using technology to grow your practice, deepen relationships, and save time. As you start tackling some of your action items, know that we're here to help you. If you have questions, give us a call or visit principal.com/growyourpractice for more information.
I'd like to start off with a little story. There's a gentleman who was a writer from the New Yorker, and he was having trouble communicating with his 12-year-old son. He noticed there was not a lot of conversation at the dinner table, and this gentleman was a little bit of a Luddite. He was one of the last people to have one of those flip phones, and he noticed his son was always on his smartphone. So the gentleman broke down and decided to buy a smartphone, and he noticed an immediate difference. His son's texting him all the time, and he's so excited about the better communication. But he still doesn't understand all the acronyms that go along with the digital world. He asked his son a lot of questions, but there was one acronym that his son used in almost every text that he felt needed no explanation, and that was LOL. He's like, oh my gosh, that is so amazing. It must mean lots of love. So he started using it in all his communications. His sister texted, said she's getting a divorce. And he said, sis, I just want to let you know I am there for you if you need me, LOL. His dad texts the entire family. He's having a health issue. He said, Dad, you are the strongest person I know. You're going to get through this, LOL. Oh my goodness, he's doing it all the time. Finally, he's in the airport. His son is texting him on a serious matter. And his son asks him, Dad, do you know what LOL means? Of course, comes the answer, son, you taught me. It means lots of love. I think we all know, no, comes the reply, Dad, it means laughing out loud. And you all know that moment when time stops. This gentleman's thinking about all these interactions where he was trying to send out love, but the recipient got something very different. The same thing happens to families when they try to talk to each other about money. One person shares one thing, but the recipient hears something very different. But today, I'm going to share with you some in-depth research T. Rowe Price did around intergenerational wealth transfer, how families talk to each other and how they talk to their financial planner. I'm going to share with you a few questions to help you narrow down your focus to a handful of clients most at risk. And then finally, I'm going to share with you some best practices from other financial planners on how they establish relationships with the entire family. But first, I'm going to share some stats specifically designed to scare you. $70 trillion is going to be transferred over the next 25 years. 21% of your clients will likely experience a wealth transfer in the next decade. I was talking to a financial professional that I've known for a long time. He's been in the business over 30 years about this topic. And he shared with me when he first got into the business, it was really rare to have a client pass away. Fast forward to today, the past year, he's had over 9 clients pass away. And if he just looks at the demographics of the clients that he's serving, he knows that's going to continue to increase. And last but not least, 70% of heirs plan to change financial planners when a wealth transfer occurs. Now, this is when I can get a couple of skeptical glances. You may not trust this stat, but cut that number in half can still be a significant risk to your practice. And in fact, Cerulli did some research with financial planners. And it turns out the number one reason that clients leave is because they have passed away and the heirs change financial professionals. One of the things when I'm talking to financial planners, I hear from them most often is that, hey, I have a great relationship with the household CFO, that primary decision maker for investments. But sometimes it can be a challenge to connect with the partner and the children. One of the things I recognize is that it is completely unreasonable for you to be able to connect with every single family member of every family that you serve. So at T. Rowe Price, we developed 3 simple questions to help you narrow down your focus to the most important clients. The first question, how many of my top clients are in their 70s? Now, why did we choose 70s? We actually think 70s is the last lucid decade. Now, I know that's a bit of a morbid term, but let me share a couple of stats that back that up. The CDC states that 25% of Americans age 75 or older consider themselves in fair or poor health. Now, on a scale of 1 to 10, 1 being perfect health, these are individuals that score 9s and 10s, that self-score 9s and 10s. And how many of you have had a client experience a health crisis? Becomes all-consuming, right? The second stat, same source, CDC, to me is even more sobering. 50% of Americans age 80 or older, 50% of Americans age 80 or older have been diagnosed with dementia or 1 stage below dementia. Now, I know dementia is a progressive disease that progresses at different rates with different people. But if you're dealing with a competency issue or a health crisis with your clients, there is no room for anything else. The other thing to consider is the age of the children of your clients in their 70s. So think about it, probably in general, in their late 30s or 40s. They haven't hit that magic number 50, likely don't have a financial advisor, but potentially have accumulated a significant amount of assets in their employer-sponsored retirement plan. So it may be a really good time to interact with them. So if you think about the total assets under management of clients in their 70s, that's potentially what's at risk for you and your practice in the next decade. So just take a second and think about a top client that you have in their 70s. You have a great relationship with that household CFO, but you see an opportunity to better connect with their partner and their children. Now think about that client specifically. How many engagements in the past 12 months have you had with the partner or the children? And guess what? An engagement is not sitting across the table from 2 partners. One person has that 1,000-yard stare, right? They're not paying attention, they're not engaging with you. An engagement is actually connecting with that person on what's important to them financially, which oftentimes is very different than the priorities of that household CFO. So we're going to talk about how to connect more with that entire family right now. So in this proprietary research that we did, in-depth interviews, we spent 2 hours with the older generation, younger generation. We talked all about intergenerational wealth transfer, how they communicated with family members, and how they communicated with their financial professional. And there were a couple of universal truths that we heard from all the participants in our research. The first universal truth was, I want to be fair. Fairness was critically important. The second universal truth was, I don't want to cause my heirs pain. By definition, a wealth transfer is a painful process for a family, right? They don't want to cause their heirs additional pain. But fairness and not causing heirs pain has become more complicated with the change in the demographics of the American family. If you look at the silent generation, the vast majority of individuals in the silent generation were in what we would call traditional family structure. Simply stated, it's a married couple with kids. But what's really interesting is that majority has shrunk to a third today in a portrait of today's American family. And what's taken its place is this rise of a modern family. So what's a modern family? It can mean a lot of things. It can be a same-sex couple. It could be multiple generations within one household. But most frequently, we hear that a modern family is individuals that are on their second or third marriage. And now just take a second and think about, what is fairness in that situation? And what's really interesting is, obviously, it's not immediately apparent to individuals in that situation what fairness means. So with the individuals that were in our research in that situation, what do you think they did about it? Absolutely nothing, right? They said, I'm going to stick my head in the sand and pretend that this problem is going to go away. But we all know this problem doesn't go away. And we've seen time and time again, families torn apart. They're absolutely going to cause their heirs pain if they don't make their wishes known to the next generation. But herein lies the opportunity for each one of you. If you can help your clients navigate these complex situations, their heirs are going to appreciate you and continue to work with you. So we did all this proprietary research, in-depth interviews with all these types of individuals. And what did we find out? Families fight about money. Shocking, right? There are these ongoing conflicts that inhibit their ability to connect with each other and oftentimes put you as the financial advisor right in the middle. The good news is, though, is that we actually saw a pattern in these conflicts, and it's connected to individuals' attitudes and beliefs about money. Each one of you and every single client that you serve has their own unique attitudes and beliefs about money, often based on early childhood experiences. But what we see happen is that family members make the mistaken assumption that their partner, their parent, their sibling, or their children have the same attitudes and beliefs that they do. And they just can't understand why this person has a different point of view. But as I take you through this framework, you can start to understand just being aware and just helping your clients become aware of the different attitudes and beliefs that each family member has can actually start to change the conversation. So let's get into the first one, spenders versus savers. What's really interesting about this is the vast majority of individuals in our research said that their partner was the opposite of them. Now, I know, opposites attract, right? But not in every situation. So we dug a little bit deeper and we realized that this is a relative term, meaning the more extreme tightwad perceives their partner as a spender, even if they aren't necessarily that big of a spender. You can see the quote on the screen. If only my husband would stop saying, "Why did you buy that?" was one of our participants sharing in the research. She went on to say that she bought a new outfit once every decade or so. This was no Imelda Marcos, but she spent more than her partner. So her partner perceived her as a spender. Now, I think it's important to note that attitudes in and of themselves are not right and wrong, right? They're just attitudes. I recognize the saver is the reason they're your client. But how many of you have had a client that has saved more than enough for retirement? You almost have to convince them it is okay to spend a little money to enjoy your family today. In moderation, there can be validity to both points of view. So let's get into the second one, security versus opportunity. This is a big one that actually oftentimes falls along gender lines. And I'll just share with you, I am sharing some generalizations, and there's always exceptions to generalizations, but in general, women value security much more than men. Gartner does some independent research. Every year they survey Americans about what they value most. It turns out that women value security 29 points higher than men on a 100-point scale. That's a significant difference, 29 points higher than men. But what is security really? I mean, security can be where you live, where you send your children to school. But when we're talking about investments and wealth management, security can often come up when you're talking to your clients about risk tolerance, right? How many of you have been sitting across the table from a couple? One partner says, I want to put my money under my mattress. They say, I remember what happened in 2008. I don't know what's going to happen 12 months from now. I want to be safe. Then on the other extreme, you can have a partner that says, I'm aggressive. I'm an investor. I want my money to grow for me. You have two people, and I recognize this is an extreme example, so you're not necessarily going to see this all the time, but you have two people, completely different risk tolerances. What do you do? And in my interactions with financial planners, I ask this question all the time, and I've gotten a lot of different answers. One financial planner shared with me, he said, Jean, that's pretty easy. He said, when I have that situation, I put them in a moderately aggressive model. And while that might be perfectly appropriate in terms of their asset allocation, just think about the person that values security. Do you think that they feel really comfortable about even the words moderately aggressive, that word aggressive in the model? It's important to make sure you're checking in with that household CFO as well as the non-household CFO. Sometimes we call it the silent partner, that person less involved in decision making, and make sure you surface any concerns. And oftentimes, especially in older clients, that non-household CFO can be a woman. One piece of advice I share with all financial planners is the next time you're doing a financial review with a couple, ask a simple question. The question is, what concerns do you have? Not, do you have any concerns, because that's a yes/no question. Just ask them, what concerns do you have? You're sitting across the table from the CFO and the non-household CFO. Who do you think is going to answer the question? The household CFO, of course. They're going to say, I don't have any concerns. I feel really good about our plan that we've developed. Thank them. And then turn to the non-household CFO. Call them out by name. Let's say it's me. Say, Jean, what concerns do you have? And then I want you to sit and wait in that uncomfortable silence. I love uncomfortable silences, until finally that other partner is likely going to share some concerns that you weren't even aware of. And that's one thing that we heard in our research is those non-household CFOs oftentimes have concerns, but can be reluctant in sharing those concerns with you. So that is why it's so important for you to draw out those concerns and address both partners. You know, one interesting tidbit I heard from a financial advisor recently in our current environment. She said, you know what I'm doing? She said, I'm reaching out to my clients via phone. I'll put a reminder on my calendar. But she said, for each family, I'm not putting one reminder, for each couple, I should say. I'm not putting one reminder, I'm putting two reminders. I'm calling, I'm talking to the household CFO usually for that first conversation, and then maybe a few weeks later, I call again. And If I get the household CFO, that might be a little bit of an uncomfortable conversation, especially if they're not used to me talking to their partner. But now is such a great opportunity to educate those household CFOs and say, you know what? It is so important for your partner to know who to go to if ever they need to talk to someone about their finances. And it's so important for me to develop relationships with both you and your partner. So that's the reason that I wanted to talk to them today. And you get that non-household CFO on the phone, and the first thing you say, you're not going to talk about financial markets. You're going to say, hey, I was just thinking about you, and I was wondering how you and your family are doing during this time. So making sure you're connecting with both partners is critically important. The second thing I just want to share with you in terms of communicating with clients is that each one of you is suffering from an affliction. And that affliction is called the curse of knowledge. Have any of you heard of this? Every subject matter expert in any type of industry has this. Simply means that we've developed our own language as financial experts to describe things, and oftentimes that language is devoid of emotion, and words mean something to us that don't necessarily mean things to people outside of our industry. And oftentimes people don't even know what we're talking about. We're using a lot of jargon. This happens to me every time I have a technical issue. And trust me, I have a lot of technical issues. I call the T. Rowe Price help desk, IT help desk almost daily. They know me by name. But oftentimes they'll spout out some words that I don't understand. They're like, what's your API, C3PO? I have no idea what they're talking about. Do you think I admit that to them though? Of course not. I don't want to appear stupid or worse, old. And so we fumble along with some suboptimal solution, and that's why I'm calling them again the next day. The same thing happens with your clients, especially those non-household CFOs, when you're using words they don't understand. One financial planner shared with me, he said, you can see when clients kind of get that look in their eye, they're not necessarily following what you're saying. He says, I don't wait for them to ask the question. Let's say you were talking about inflation. He said, I'll ask the question for them. I'll say, hey, if I were in your shoes, here's what I would want to know about inflation. And the last thing I just want to share with you about the curse of knowledge is that the words financial professionals use can be loaded at times. And one key example of this is the word risk. So, risk to people inside the financial industry is an analytical term that we talk about. But to people outside the financial industry, the word risk is a loaded word with emotions, and it differs based on gender. To men who are not financial experts, that are not working in the financial industry, the word risk actually has a positive connotation. Risk is good. Risk is I'm going to go out and feed my family. Risk is necessary for survival. But to women who don't work in the financial industry, the word risk has a negative connotation. Risk is something that you do that's bad that may or may not have a negative outcome. Risk is not wearing your seatbelt. Risk is not putting your children in a car seat. So when you're asking a woman, what's your risk tolerance? And she replies, I want to put my money under my mattress. Of course she says that because she's hearing something different than what you're saying. And here's another opportunity for you to take back that loaded connotation of that word and talk about goals and objectives and trade-offs. You can certainly put your money under your mattress, but the money is going to actually not be able to pay for the same amount of goods 5, 10, 15 years from now. So asking questions, communicating with your clients, recognizing that jargon can be loaded and sometimes not understandable to clients is important in order to connect with that entire family. The next dynamic is around individuals' preferences for talking to family members about money. About 50% of the adult population is what we would call open to talking to family members about money. You know these clients, they're the ones that bring their kids in to meet you. But this other 50% of the population, and this is even more prevalent in high net worth individuals, is in some way reluctant to talk to family members about money. Sometimes partners, oftentimes adult children. And there's actually many reasons why people value privacy. They don't necessarily want to talk to family members about money. Oftentimes we heard from participants in our research, they said, hey, it's none of my children's business, about my finances. It's my money, I earned it. We also heard from that older generation, they said, especially high net worth individuals, they said, I don't want to demotivate my children by talking to them about my financial situation. I want them to be successful on their own. And herein is another LOL moment, because when we talk to that younger generation, oftentimes we heard, I'm not even worried about mom and dad's net worth. I just want to make sure mom's going to be okay. I need to know, do I need to buy an in-law suite? So recognize, oftentimes communications can stall because individuals are perceiving different motivations from family members. Another quick story to share with you. There was a lady in our research. She came from a lot of wealth, had been passed down from generation to generation. And she shared with us, she said, you would never know how much money I have by the car that I drive or the house that I live in. She said, my friends will complain about college tuition expenses, and I stay silent. She said, I don't want anyone to ever find out my true wealth because it would change their perception of me. They may treat me differently. Worse yet, they may ask me for money. And she went on to say, and I'm never going to talk to my children about money because the first thing that they would do is post it on Snapchat or TikTok. And in today's environment with social media, it can be very fraught for an individual that values privacy. The last dynamic that I want to talk to you about is around individuals' interest with finance and markets in general. Oftentimes that household CFO that we talked about, that you interact most with a family, they're fascinated by financial markets. They enjoy talking to you about what's happening in markets or individual securities. It's something really interesting and enjoyable for them. But there's this other part of the population that doesn't necessarily view talking about money and financial markets enjoyable. They recognize that it's very important, but it feels more like an obligation to them. Talking to you can feel like going to the dentist for them. It's very important, they're going to do it, but it's not necessarily first on their list of fun things to do. So this is another dynamic to recognize. Perhaps the conversations that you're having with that household CFO are satisfying to them, but that other partner may be interested more in discussing their family, their financial goals, their family's vision. So let's put this all together. Go back to that top client. In their 70s, you have a great relationship with the household CFO. You can see an opportunity to connect better with the partner or the children. Now just take a second and think about their specific family dynamics, what each family member's attitudes and beliefs about money are. This can help you learn more about all the family members and find relevant ways to connect beyond the household CFO. So I'm just going to give you a quick example. We've got Daniel and Nora. Daniel and Nora have been your clients for over 20 years. You have a great relationship with Daniel. He's the household CFO. You definitely put him as a saver. You'd put Nora a little bit more on the spender side. You know that they've had some disagreements over time with budgets and spending. You'd put their daughter, Anna, more on the spender side because you know that Daniel and Nora had to bail out Anna in undergraduate. She got into some credit card debt. Every time you see the household CFO and even the couple, you ask a simple question: how's the family? And I'm sure many of you do this already. Hey, Daniel, how's the family? Sometimes, not all the times, sometimes this is going to give you relevant ways to connect beyond that household CFO. So, hey, Daniel, how's the family? Oh my gosh, I'm so excited. Anna just got her PhD. She's off the payroll and she got her first job. What a great way to connect. You say to Daniel, congratulations. Then ask his permission. Hey, Daniel, what if I called Anna and helped her set up her retirement plan at her new job? Now just think about this for a second. You're asking Daniel, who's a saver, to help his spender daughter start saving at one of the best times in her lives, her first job, right? And then think about it from Anna's perspective. You're not calling Anna and saying, hey, Anna, I'm your dad's financial planner. Is there anything I can do to help you with? Because we know that always works, right? No, you're calling Anna and saying, hey, Anna, I'm your dad's financial planner. Congratulations on your new job. Would you like some help filling out your retirement plan enrollment form? And just think about it. Anna does not have her PhD in finance. This is my story. So Anna does not have her PhD in finance. She has no idea what the terms on an enrollment form for her retirement plan mean. Large cap growth and small cap core and even target date are foreign to her. So this is just a small percentage of your time, but it's a relevant connection to something that's important to her. And it's important for you to just to think about, it's almost like you're playing the role of a detective. The more you can learn about the partner and the children, the more relevant ways you can find to connect. One quick example I'll ask all of you is just to think about, how many of you are connected with your clients on LinkedIn? And most financial planners tell me yes, although I recognize there's not a lot of 80-year-olds on LinkedIn, right? Then I'll ask the second question. How many of you are connected with your clients' children on LinkedIn? Usually the show of hands gets considerably lighter, but think about it. And again, I'm not suggesting you're messaging them, just connecting with them. If you connect with your clients' children on LinkedIn, you're automatically going to be notified every time they change jobs. And again, what a great relevant way to connect. Hey, Anna, congratulations on the new job. Can I help you with your benefits? And oh, by the way, they likely have a rollover from a prior employer. So the more you can learn about the entire family, the more relevant ways you can find to connect. So one of the things I think is critically important is recognizing the needs of the partner and the children are often very different from that household CFO, especially the next generation. So at T. Rowe Price, we actually created a series of financial planning checklists that are focused on the needs of the next generation. I recognize you spend a lot of time focused on retirement income, estate planning. These are complex topics. But oftentimes the next generation knows that retirement is important, right? But they have higher priorities. They're getting married, changing jobs, having children. And if you can connect with them with those, with what they perceive as more pressing financial priorities, I think you can gain traction and gain a greater relationship with them. So these financial planning checklists are designed for you to use not just in conversations, but feel free to copy and paste them. Put them in your communications to clients or on social media. And you can talk to your T. Rowe Price representative to get access to these financial planning checklists. The last thing I just want to share with you around intergenerational wealth transfer is oftentimes, I've seen advice from individuals on intergenerational wealth transfer that focus on the family meeting. They say minimize your risk of losing assets by having a family meeting. And for your clients that are open to talking to family members about money, family meetings are really fruitful, right? And you can see on the screen the vast majority of individuals in our research that had family meetings, although maybe they viewed it with trepidation a little bit, they felt like it was a positive experience. We sat down, had a meeting, and went over my parents' finances. It felt good to know and gave me a sense of peace. But I think it's also important to think about that request from your clients that value privacy. Now just think about it for a second. When you're asking those clients to have a family meeting, you're basically asking, hey, can you get together everybody that you love most in the world, probably around the holidays, and talk about what happens when you die? Your clients are polite people. They're going to say, yeah, that sounds like a really good idea. Next year, right? And next year never comes. So my suggestion is for those clients where family meetings aren't having success, you're not having success getting a family meeting, identifying the needs and the attitudes and the priorities of the partner and the children are going to be the way that you're going to connect with that entire family. And oftentimes they can become advocates working alongside with you to convince that household CFO that a family meeting is important. So I want to thank you all for your time today. Thank you so much.
Good day, RPAG members. Thank you for joining our session today as we talk about individual accounts and whether to keep them in place or to consolidate them. I know many of you wish that you were flying into John Wayne the last couple of days, or maybe even into LAX and driving down the 405. But since we can't talk about the 405 freeway, let's talk about other numbers that are in the 400s, such as the 401k, 403B, and the 457B. So let's start with the 401k and individual accounts. And what I'm referring to is self-directed brokerage accounts. You see, as advisors, we're used to working with group plans, but their professional service firms, oftentimes doctor groups, medical groups, will have self-directed brokerage accounts. And it creates a lot of complexities for the plan sponsor as well as participants in collecting data, tracking information, and all the administrative work that goes along with it, in addition to the costs. Well, today we want to talk about how we can help you with those type of accounts. And how do you get there? Well, a lot of times you'll have a doctor, let's say, that's looking to move over to a new firm. His current employer, he's allowed to have his 401k with his current advisor that manages his personal assets. One of the stipulations for him to move to the new company is to keep that 401k in place. They agree to it, he comes over. Next thing you know, you've got another doctor wanting the same thing. Before you know it, you're an employer that has 30 doctors with 30 self-directed brokerage accounts with multiple brokerage firms. What do you do to make sure that that plan is running functionally well? We're going to talk to you about that. So I brought on one of our experts here. I want to welcome today John Kibbe. John's our regional director here at One America, based in Atlanta, works in our large markets, and he has extensive experience working with self-directed brokerage accounts with multiple providers. So, John, I want to welcome you.
Well, thank you for having me, Kara.
So, John, I thought what we do is do a little bit of Q&A and have you talk about your experiences and what you've come across in the professional services firm so that our advisors that are joining the session today can learn a little bit more about this space. So let's go ahead and get started. So John, start by telling us some of the common challenges that you see in the self-directed brokerage account space.
Well, as you mentioned, obviously we've got a vast amount of experience in professional services firms. And one of the key things that we see in professional services over and over and over again, and this is no surprise to the group today, is self-directed brokerage accounts. And in some cases, they are the bane of our clients' existence because of the challenges associated with administering those accounts. What are the challenges that we face? Most of the time, you've got two paths that you can go down with self-directed brokerage accounts. You can work with a vendor that has a proprietary or built-in or automated self-directed brokerage system, or you're working with a provider or a third-party administrator that allows you to use multiple providers to provide these benefits for participants. Now, we all know the individuals that we're talking about as it pertains to self-directed accounts, right? It's the doctors, it's the partners within the law firms, folks with very high balances, folks that are more sophisticated when it comes to their investment management, and folks that have strong relationships with typically existing investment advisors, and they want to continue those relationships. And that's where the real challenge lies for the plan sponsor, is handling all those different accounts at all those different locations, controlling what's happening and understanding what's happening inside of those accounts, and then administering the plan appropriately. So it creates an immense number of challenges. If you think about law firms, for example, law firms typically work with publicly traded clients. When they're working with publicly traded clients, they have restrictions that they're within their attorney's ability to invest in those clients, whether intentionally or unintentionally. How do we track that? How do we ensure that we're doing that appropriately? Inevitably, limited partnerships, property, other strange collectibles, how are we controlling what's happening inside of these accounts when we can't see what's going on a day-to-day basis? And more importantly, audit costs. When plan sponsors have to pull in data from multiple sources and it's not automated, that requires a full scope audit and the challenges of collecting and gathering that data. So you have massive issues with collecting data. You have massive issues with overseeing the information that's going into those accounts from a fiduciary perspective. You've got titling concerns, right? Are the accounts being titled appropriately to make sure they're truly assets of the plan, et cetera. So there's a lot of things that go into it for a plan sponsor. It's something that we think should be very simple and easy to administer.
Well, you certainly mentioned a lot of challenges there, so I can see why, a plan sponsor or sometimes even participants would be frustrated or struggle with their accounts. One of the things that you mentioned is collecting data. So how do you go about doing that? What technology is in place to collect that data?
Well, unfortunately, industry-wide, there's not a lot. I would tell you probably 90+% of the time, this is a very manual process, which is part of the big challenge that our clients face today. Unless you're working with a provider and everybody has their account in one place. So if you're working with a provider that uses TD Ameritrade as their brokerage window, and that's the only thing available, it's fairly simple. It's an automated system and everything is automatically collected and sent to the plan sponsor. In the more likely scenario that you've got multiple accounts at multiple wirehouses and multiple investment firms, it's a very manual process. And so the head of HR, the person administering the plan, or the TPA has to reach out directly to each advisor, each wirehouse, and each participant to gather the data every quarter, every year, in order to make sure that that information is flowing through appropriately. One of the benefits of working with our organization is we've built an automated system, whether you're working with a dedicated self-directed brokerage scenario or you're working with multiple wirehouses, multiple investment firms across the country. So there are technology platforms that you can invest in that will allow you to automate and streamline the entire process.
You make a good point, John. I think if an advisor has ever worked with an existing client or they've even had a prospect, that it's pretty labor intensive having to collect that data from the various brokerage firms. And we all know that that takes a lot of time. So I think what you mentioned, having the technology to automatically do that can make a big difference. One of the things you also mentioned was around tracking. So how do we go about tracking those restricted investments?
So that's, again, another big challenge in the industry. I can't speak to everybody's practices, but I can certainly speak to how we do it. And one of the benefits of having an automated system is it allows us to pull in data on a daily basis. So what we do here at One American is we pull in transaction activity every single day from every single brokerage firm, from every single self-directed account, no matter where it is, electronically into our system. So for a law firm, for example, that allows us to track restricted investments. And so we can generate a report that will list out all the transaction activity, and we can call out individual positions if we need to. That way, the law firm can ensure their partners are not intentionally or unintentionally investing in clients where they're not permitted to do so. The whole thing is built upon access to data, and the fact that we can pull this information in on a daily basis is what allows us to do this effectively for the client.
And you mentioned with the data collection and tracking of these investments, how many different firms do we have those capabilities with roughly?
So right now we roughly have about 70 and growing. It's most of the names you know, and then as we get down into the 50s, 60s, and 70s, and some of the more independent wire shops. But all of the main wirehouses that everybody's familiar with, all the main broker dealers, have all built electronic links inside of the system that we currently utilize to gather data. And I think what's important about that is that data feed is coming to us on a daily basis and is reconciled to our record keeping and trust system every single day. That means that there's the data integrity is there. The client can be rest assured that when they log into their system, what they're seeing is accurate as of the close of business that day. Where in a lot of cases, if that information is trickling in over time, different participants and different clients have different experiences. We eliminate that through the daily data feed.
Yeah, it sounds like a pretty extensive list then to be able to work with roughly 70 different firms to get those automatic feeds. Speaking of client experience, you mentioned logging in. Share with us how One America can help improve a plan sponsor and a participant's experience, if they do have these self-directed brokerage accounts all over the place.
Sure, and I think most of the people in your audience today, they're familiar with this. They've seen what the participant experience can be like and the challenges associated with it, right? Is you've got a partner or you've got a physician that has their good friend, they want to manage the money, they go and they set up an account, and then they tell their plan sponsor, hey, I just set up my retirement account with my good friend here over at Merrill Lynch. I need to get it turned on. And the client loses their mind because they're, well, wait a minute, how did you set up the account? How did you title that account? Where am I supposed to send the check? How do I get money into the account? Huge challenges that we don't always think about on a day-to-day basis as to how is this participant going to just get his account set up, let alone have access to the account on an ongoing basis. All of that, from our perspective, we drive that experience through a dedicated service team committed to nothing but working with self-directed brokerage participants. So what that means is our plan sponsors and our clients and our advisors can direct participants that want to engage in self-directed accounts directly to this dedicated service team. That service team will work with the participant, the sponsor, and whichever investment shop they're working for to ensure the account is set up appropriately, it's titled appropriately. And the beauty of it when we do it this way is our team sets everything up internally so the entire process is automated for the plan sponsor. No more sending 8, 9, 10, 50 checks to 50 different wirehouses for 50 different accounts. We can aggregate that data internally. The team that does nothing but work with self-directed brokerage takes that information, ensure the money gets populated with proper accounts. But most importantly for the sponsor, from a fiduciary perspective, is we can ensure the accounts are set up, titled appropriately, and that data sharing is happening from day one. It's a huge value add to everybody throughout that entire process, and it pulls the plan sponsor out of the vast majority of administering anything around these self-directed accounts.
Yeah, you bring up a good point. I think we're seeing more and more where plan sponsors are looking to offload a lot of the work that they have to do in the retirement plan, right? Because it just becomes a big project. So by having the team at One America that will work directly with participants, that reduces the workload for the plan sponsor as well, it sounds like.
I give you a great example of that. We have a law firm, recent law firm client that just came to us very recently. And they were receiving over 700 proxies per year, paper form delivered to their offices with no indication as whose proxy it was, where it should be going, who should be getting it, nothing, just random proxy statements from 35 different brokerage firms for what amounted to somewhere in the neighborhood of 60, 65 different people. We were able to pull 100% of that off their table. They no longer receive proxies unless they wanted copies of them. They no longer receive paper proxies. Everything is, we track and ensure that all proxy statements are being sent exactly to the participant that is intended to get them. And we eliminated that completely from their world.
Yeah, that probably really helped the plan sponsor not to have to worry about what to do when they got this big box of proxies every year.
Well, they have a very large ERISA team, and their ERISA team was really uncomfortable and really not happy with the way this was going. It didn't understand why it was happening the way it was, but the ability to automate it, put them at ease from a fiduciary standpoint, and obviously eliminated a pretty significant burden from the client.
Yeah, I bet it's one of those things that the client never says, hey, I wish we could go back to the way it was and keep getting those proxies in the mail, right? Well, John, I'd love to continue to spend more time with you on this topic. It's somewhat of a complex topic, and when you first take a look at it in terms of what to do, because there are so many challenges, whether it's collecting the data, tracking the information, just the experience both the plan sponsor and the participants have. But in interest of time, we do have to say our goodbyes. But if it's a topic that you as advisors are working with a prospect, or maybe even one of your existing clients has many self-directed brokerage accounts all over the place, reach out to myself or John. Our contact information is available, and we will be able to help you or walk you through how we might be able to improve their situation and make it a little bit more seamless and automated with having all these self-directed brokerage accounts. So John, thanks for joining us today. Certainly appreciate your time.
Oh, thank you for having me, and enjoyed being here. Thank you.
John, do you hear that noise?
No, I don't hear anything. Should I be hearing something?
It sounds like a bee. You don't hear that bee in the area?
A bee? No. Kara, I'm extremely allergic to bees. I've got to.
All right, John. Well, good luck with things. Don't get stung by the bee.
Well, John, that's frightening to hear that you're allergic to bees, and we certainly don't want to have you get stung by a bee. So get out of here. Get out of here. Well, speaking of bees, let's switch gears and talk about 403Bs and 457Bs. And in these type of plans, while we just got done talking about keeping the individual accounts in place, a lot of times you'll find these type of plans that have individual contracts, and we want to consolidate them to help create better efficiencies for the plan sponsor as well as participants, reducing costs and making it more administratively feasible for the plan sponsor to manage. So without further ado, I'd like to welcome Brian Giles, who's our Regional Vice President in the tax-exempt space, to join us today for a little Q&A talking about how we go about consolidating these individual accounts.
Thank you for having me.
So we spent some time talking about the individual contracts in the tax-exempt space with the 403B plans and the 457 plans. Are you still seeing that today? What are you seeing out there in the marketplace?
Yeah, absolutely. I mean, the individual contracts are a part of the 403 marketplace, and it's not going away. However, we're absolutely still seeing the trend of continued consolidation away from individual contracts into a group contract. This is especially true when we're talking about ERISA 403B plans, where the plan sponsor really wants control over the plan assets, and that's really to help them fulfill their fiduciary obligations. And then a couple other trends that we are seeing along the lines of this topic is we're seeing multiple provider structure really being targeted in the ERISA class action lawsuits that we're seeing in the space. And really the crux of all that is around when you do have a multiple provider situation, that the sponsor is not able to really leverage all of their plan assets and use that as scale to drive down their potential plan pricing. And when we talk about multiple vendor situations that we see targeted in lawsuits, a sponsor can find themselves in that situation either by choice, where they've made an active decision to have multiple record keepers, or it could be due to the result of they have individual contracts, and therefore they just aren't able to consolidate all of those into a single provider. So they're dealing with multiple provider situations. So this is an opportunity where we see advisors being able to consult with plan sponsors around best practices on this. And then a second trend that we're seeing is around the recent 403B restatement process, as well as legislative updates that sponsors are doing for the passage of the Secure and the CARES Act. And in this case, again, we usually see one plan document that controls all of the plan assets. And so when you have a multiple vendor situation, because you may have individual contracts with other providers, you still have that one document that governs everything. And so usually it's either the provider that has the group contract, or it could be a TPA that's handling your plan document. And so if you're making updates and updating provisions during the restatement process, or if you're taking advantage of some of the features and options that have come out of the CARES Act, sponsors need to be careful and make sure that they are actually administering the plan across all vendors, so that they have consistency in the terms of their or how they're administering their plan, making sure they're doing that according to the terms of the plan document. So that's another emerging trend that we're seeing, where advisors can come in and make sure that sponsors are having conversations across all of the vendors in their retirement plan.
Yeah, you bring up a really good point, Brian. You know, we've got really kind of two things going on here. You have these individual contracts that are providers, but then there's also plan sponsors that not only have individual contracts for their participants, but they might be dealing with multiple providers. So the investments are all over the place.
Correct. Yeah, and that's in essence the nature of when you have individual contracts. It's challenging to move into 100% of a group contract setting, just due to the nature of the sponsor not having control over those. So usually when we see individual contracts in a plan, that setting or structure is around for a while. And therefore you have a sponsor that's really having to manage multiple providers along the way.
So let me ask you this, Brian, are you able to force a participant to move from that individual contract to the group plan?
Generally, the answer to that is no. So I would say the individual contracts, when we refer to that, those are contracts that are fully enforceable by the employee, and the plan sponsor does not have, any enforceable rights over those. We even see, and sometimes it can be confusing within the 403B space, because you may see and review a contract that actually refers to it as a group contract, but then as you dig into it, there are individual certificates that ultimately turn over the control to the actual participant. So when we have these situations, the sponsor really does not have control and is not able to force a transfer to a group contract. So that's why when you've got a sponsor that has individual contracts and they want to move and migrate towards a group controlled product or contract, we say this is really it's a journey for them. This is not a one-time event. It takes time to get assets migrated over to the group contract.
Yeah, I think you hit on a good point there, that it's this isn't something that happens overnight, moving from the individual contract to the group plan. It takes time and definitely takes some patience. Speaking of which, so how do you get those individual contracts moved over to the group plan? What does that look like?
Sure. So for ERISA plan sponsors, if the sponsor has not already done so, we usually see the first option would be to require all future contributions be made to that group contract. So you can kind of try to draw a line in the sand and stop the bleeding, so to speak, and say, all right, we as the plan sponsor, we are gonna require all future contributions to go into that group contract that we have control of and over. And then it really comes down to tackling the individual contracts that are left behind that we just spoke about, where the employee has ownership rights over those, so the sponsor can't force those over. So then we really get into how do we get those contracts effectively transferred over to the group plan. Mm-hmm. And what we have found is that the plan sponsor engagement and involvement in this process is a significant factor in having a successful process put in place where you can actually get assets to transfer over. We have actually seen where we have strong sponsor engagement and involvement, we've seen up to 90% of those assets transfer over from the individual contracts to the group contracts. So really what it takes is a lot of hand-holding at that participant level And what I mean by that is it really takes the involvement of for One America in our structure and our support. One America provides an asset consolidation team where our team's willing to get on the phone with that current provider of the individual contract. One, to talk through, make sure that we get the right form in here. So sometimes folks might think that this is a rollover, but this is not a rollover out of a plan. So this is really a plan-to-plan transfer. So we make sure that they get the right transfer form from their current provider. And then we find that it really simplifies the process if we can have somebody in particular on our team that understands the process pre-fill the form. And so that it's really just a signature ready form for the participant to sign. And then just knowing the nuances of how each of the various providers out there that we know we typically offer an individual contract setup, just knowing how they operate. So, we know which providers may require that you collect all the individual contract transfer forms and send them over to them in bulk so that they're processed properly, or versus those that want them to come, on a one-on-one basis. So just knowing each of the nuances of the providers can be extremely helpful in the success of moving over those forms. And then I think the last thing I'll say is just having a tracking mechanism in place is critical, so that we have somebody that is tracking the individual transfer process from start to finish.
Yeah, that's a good point, Brian, when you say tracking process, because unlike, a 401k transfer, it's not just usually a lump sum wire that goes from one place to the next. A lot of times it's check by check being sent in the mail, and somebody's got to keep track of all those transfers coming in.
Correct.
Yeah. Now, one of the things you mentioned too is that it's really important to have the plan sponsor engagement and get them involved. And I heard you say that sometimes you can get up to 90% of the assets that come over. That's great. But you said 90%. So I didn't hear 100%. And I think we would both agree that it's almost next to impossible to get 100% of the assets to come over, because as you alluded to earlier, you can't force a participant to move if they don't want to move. So what happens? What do we do if we can't get all the assets over?
Yeah, so when we have situations, and that's the reality for a plan sponsor that has had individual contracts in their plan. That their reality is going to be that they're going to have some assets that are left behind with a prior provider, and so they are faced with the challenge of managing plan assets at multiple record keepers or multiple providers. And so that just adds some additional challenges to the plan administration when you have assets at two different places. And so this is really where, for those that work in the 403 marketplace, know this is really where we see information sharing coming into play. And the primary way that we see information sharing being leveraged is around loan administration in particular. So this is where, if you have a participant that's maybe in the group plan, they want to take a loan, we need to know whether or not they have an outstanding loan in an individual contract with another provider. And so that's where the information sharing is extremely useful. And that's where, One America and other providers that leverage information sharing, are able to take that outstanding loan data that might be with one of the individual contracts at another provider, and they can actually feed that data into the loan modeling system. So at One America, we have a participant who wants to take out a new loan. They go into the loan modeling system. Our system, we will pull that information from the information data sharing hub from the prior provider, and we'll be able to get that information to know whether or not they have an outstanding loan already from an individual contract. And the other piece of information that we need to know is if they do have an outstanding loan, what is that highest outstanding loan balance over the last 12 months? And then that gets all factored into the loan modeling system, so that when the participant steps through, if a plan only allows for one loan and they have that outstanding loan with, out of an individual contract with another provider, then the system's smart enough to stop that and let them know that they're not eligible to take a new loan. So that's really where we see information sharing being leveraged, is through that new loan administration process.
Yeah, great. Thanks, Brian. It sounds like there's a lot of moving parts, especially if you're working with individual contracts. It's getting the participant to hopefully move over their money. And if they don't, what do you do there? And what if they have a loan at their previous provider and so forth. So if I'm an advisor, and we have our advisor RPAG members joining us today. If I'm an advisor, how can One America help me with this process? Maybe, it's just me, or I have a smaller team and I have a not-for-profit that has, 100 employees. How can One America help me through this process?
Sure. Yeah. So I guess first I would say at One America, I feel like we're a little unique in that a third of our new business each and every year comes from the not-for-profit / healthcare market. So every year we see plans that transfer over to us that have individual contracts. So this is something that we're faced with regularly. So I kind of liken it to that for all of you who may recognize the Farmers Insurance commercial where they say, we know a thing or two because we've seen a thing or two. I would liken that to One America on the retirement side, where we come across this on a regular basis. We're asked to, on the front side or on the pre-sale side, we can help in that we're usually asked to take a look at the contracts, to examine those contracts, to see how much of the plan assets are subject to plan sponsor control versus participant control, and then are there any surrender charges that may be tied to some of these contracts that are currently in place? And then lastly, are there transfer restrictions on some of the fixed account products that are out there? So One America is here to help and be another set of eyes on all those contract provisions that may be in place. And then on the surrender charge side, we can potentially help out with buying out that surrender charge if that helps and if it makes sense in a particular situation. And then kind of moving out of the pre-sale side, where we can help when we get into the transition side, and you've got individual contracts or surrender charge transfer restrictions in place. On the transition side, our team's used to handling these situations. So here we can help set up a schedule for if we have a fixed account product that can't transfer to One America for, say, 5 years or 10 years. Our team can help set up a regular schedule so that 1/5 or 1/10 of those fixed account assets are going to transfer over each anniversary, and without the sponsor having to go and get involved to move those assets. So we can help out on the transition side. And then post sale, this is really where once all the assets that can move over to the group contract this is where we can engage our asset consolidation team that I referenced earlier. And their role is really to work with the participant one-on-one to really help them through that transfer process. So that team is more than willing to get on the phone with the participant, to call the provider of that individual contract, make sure they've got the right forms, pre-fill forms, monitor and that process from start to finish to help the participant move that transfer over. So we see a higher success rates because of that asset consolidation team, and the fact that they do this each and every day. And then, once we have the assets over at One America, we're able to partner with the advisor from an education standpoint. So education can be problematic when you have multiple providers and arrangements in place. So it could be conflicting education messages, conflicting processes and account management for the participant when assets are in two different record keepers or two or more providers, just different messages and education materials, etc. So we find it's extremely important for the advisor to partner with the plan sponsor to put together a consistent education program that's really going to drive participation and enhance participant engagement. And then lastly, I would say One America is around to help with our education team that we have throughout the United States. So if depending on your service model, whether or not you have a team that goes out and engages at the participant level, by all means, we're here to support them. And then if you don't have that capacity, or that's not part of your service model, or maybe you're just consulting at the plan level only, that's where our education teams are here to assist in going on site and driving that education one-on-one if that's exactly what you need.
Yeah, that's great. And I think what it comes down to is we're certainly here for our advisor audience and helping this to be as seamless a transition as possible. You know, anything from the very beginning stages where we can help you review that plan document or contract, to reviewing to see if there are contract or surrender charges or buyouts, or fixed account not being able to move all at once, and then even with the transfer forms and employee education. We've been working in the space for over 50 years, and I think we like to think like, hey, we've seen a lot, and like you alluded to, but I would also say no two plans are the same. Sometimes you think you know exactly what you have, and then you get into the weeds a little bit, and it's a little bit different from the previous plan. Brian, I know that you and I could talk about this topic for a long time. We could spend more hours on this, but in the interest of time, and we do have to move on. So I do want to thank you for joining us today. And for those advisors that have joined us today, thank you as well for sitting in on our individual topic. If you want more information, feel free to reach out to your local One America representative, or even myself if you have questions, and I can also get you connected with Brian as well. And we'd be more than happy to kind of go over the situation or scenario that you're working with and be a resource to all of you.
And we hope that you have found this session to be helpful. Talking about the self-directed brokerage accounts in the 401k space when you're working with these professional service firms, and why you'd want to keep them in place. And on the reverse, on the 403b and 457 side, why you'd want to consolidate those individual contracts. Certainly here at One America, we have a lot of expertise on both these type of plans. And if you'd like more information, you can certainly reach out to your local One America contact, or even myself, and we'd be happy to discuss things a little bit further with you and how we might be able to help you with a prospect or maybe even an existing client. And last but not least, I want to mention our retirement track. For those of you that are familiar with FlexPath, we have rolled out our own target date version called Retirement Track. And as a little incentive to work with us, if you sign an LOI between now and October 30th, we will be able to waive the fees up to 6 months. Or if you want to extend that a little bit further, we can reduce the fees by half up to 12 months over the course of the next year if you sign the LOI, again, by October 30th. So reach out, like I mentioned, to your One America local representative or myself, and we'd be happy to discuss that further with you. Again, I'm sorry that we couldn't be in person today. We certainly would have loved to be with you. Certainly hope to see you in the spring, and have a great afternoon.